There's one important thing that you must know about small business acquisitions before you actually dive in and decide to acquire your first company or maybe your next company if you already made acquisitions in the past. I want to break down this idea with you because nobody's talking about it, but in reality, it is kind of like a concept that is completely changing the world of small business acquisitions. That is important for you to know it before you commit to a multi-million dollar deal. For those of you who don't know me, my name is Marco Palmero. My company Ulysses helps private equity groups, search funds, advisors, and strategic buyers in identifying assets, motivated sellers that want to exit their business so that they can build a strong pipeline of deals and then focus all their time on closing transactions instead of sourcing them. So today, I want to talk about this concept of small business deals because I had a very interesting discussion with a person that was basically asking me about the difficulty in finding deals independently of the size, and he was wondering, whether he was doing something wrong, and there were some technical things that he wasn't doing in the right way to optimize his chances and kind of like maximize the chances of success in sourcing deals. But that is, subject for another discussion. Today, I want to talk more about the strategic part of it and some of the changes that happened in the market in recent years that he wasn't accounting for and that were actually preventing him from finding a deal easily and quickly. So have my little coffee going. Let's dive into that. The first thing that this person was not considering, and he was a private investor, by the way, was the fact that the market, especially in the United States, is now crowded with people that want to buy assets. Uh, 10, 20 years ago, there were less players that were actually aware of the fact that you could actually acquire a business or multiple businesses, roll them up together, grow through acquisition, and do all these sorts of things. And as a consequence, there were less people chasing more deals. Now we're almost looking at a situation that is reversed. So there are a lot of people chasing fewer deals. And that has created an environment where every single deal that you look at is going to have different bidders and a lot of people that can offer and make an offer for that particular asset. And of course, I'm talking about assets that are listed in public marketplaces. It might be on broker sites or they're coming through an investment banker, you name it. That holds true even for smaller businesses, and that wasn't the case a few years back. It used to be that small companies were not touched by big players, and there were just maybe a few investors or a few search funds looking to acquire these assets. So there was sort of like a safe space or a blue ocean, if you want to call it this way, where people can play in. And in this case, this particular investor would have had a much better time sourcing deals had he started sourcing this acquisition a few years back. Now, what has changed? Well, the first and most important thing that I already mentioned is that there are more people chasing fewer deals. That has created an environment that is very competitive in nature. And the interesting thing that I was discussing with him was the fact that he said to me, well, I was looking at businesses that are just $2-3 million EBITDA businesses, so not big companies. And I was surprised in seeing that there were a few private equity groups bidding for these assets. So we were basically competing against third parties and other parties that had capital availability and that could clearly outbid us in terms of spending power in offers because, of course, well, first, it's not their money, and second, they got plenty. So he was kind of like discussing with me, we were wrestling with this idea that it was much more difficult to submit a competitive offer, even for smaller asset. And that is something that, a trend at least, that I've seen happening in recent months and probably in the last 12 to 18 months when sourcing deals. A lot of private equity groups started to realize that it was very difficult to compete at a certain level because even in their market, there are tons of providers that are currently buying assets, and all of them are flushed with cash because private equity groups raise capital that they allocate. And if they don't find assets, they're going to be in trouble, right? And so what happened was, since there were a lot of private equity groups competing against each other, some of them started looking downwards in terms of ticket size, saying, let's try to do a little bit more of heavy lifting in finding assets that are smaller in size, and maybe we will need to buy more of them. But if we can buy them at a competitive price, at a cheap price, and have less competition, then we can combine more of them and still accomplish the desired outcome. That is, in a very simplistic way, one of the idea that some of these players might have gotten. But the thing that happened at that point was, okay, these private equity groups started looking at assets that before were not really tapped, and maybe they were only accessible to investors or small buyers. And they started competing against these new guys for these smaller deals. And so all of a sudden, people are facing a situation where they're competing against giants that have big capital availability, and they cannot really outbid them because, one, these guys can take more risk compared to them. Two, they might have capital available immediately. They don't need to wait for financing. They might raise financing, but it's easier for them to access that. And ultimately, they can offer sellers a deal that is much better, and some people might decide to go with them. As a matter of fact, a lot of them do, unless they have maybe some issue with the way private equity approaches transactions, and maybe they don't want to sell their business to them because they feel they're not going to preserve the company the way they envision. So from a competitive standpoint, this person that I was talking to was absolutely right. A lot of players are starting to compete with smaller deals for smaller deals, and that is creating a very complex situation, even for people that might not necessarily want to buy a multinational company or a business that is generating hundreds of millions in revenue. They might just want to buy a local business that is doing a couple million, maybe 10 million in revenue, 2 million EBITDA. And even in those situations, they are stumbling across private equity. And you go on public listings and you end up talking with brokers that say, well, we have 4 offers on the table, 2 of them are coming from private equity, and they're outbidding you by, I don't know, they're offering, instead of 5 times multiple, 7 times multiple. It becomes very difficult for an investor like the person I was talking to, or somebody that is trying to acquire assets on his own, or maybe even a small investment firm or a family office that is managing a limited amount of capital, to compete against offers that are way out of the ordinary. And that is one of the key challenges that you might want to be aware of if you're thinking about buying a business or buying your next business. It is becoming more and more competitive because, again, there are more players in the market, and there are more players with capital in the market, especially for these smaller assets, because people are moving downwards and then trying to consolidate more assets this way. Now, what are some of the reasons why these private equity groups are doing this? Well, the first I already mentioned. So they want to kind of like compete in an environment that is less competitive. So that's a repetition, but you get what I'm saying. So they don't want to fight against peers that might have the same capital availability, and they might be more aggressive in the way they negotiate deals, and they try to go downwards to have a much easier time negotiating deals. So they're trying to reduce the competition. But what is interesting is also that private equity and players that have capital available are becoming more conservative in their investment strategy. That wasn't the case back in the day, at least in my experience. And if somebody has a different experience, please correct me in the comments. But what I saw was that back in the day, a lot of people were more willing to take risk on certain investments because they knew that even if they made 5 investments and 4 of them were not paying out, then the fifth was going to pay for all the five and maybe make some more on top of it. So people were more, they were keen to take risks, and they were willing to bet on multiple acquisitions, um, within a limited time frame. That is not the case anymore. Even private equity is becoming more skeptical in the approach, or more conservative, if we want to call it this way. And as a consequence, we're seeing them being more focused on a limited amount of assets that in most cases end up being also the good assets. And so we have more people competing for less assets, as I said before, and in some instances, even smaller assets. So, it's kind of like a very complex situation, because the few good deals that might be available in the market are super competitive, and they kind of like have players into the picture that might outbid a regular buyer or a small investor, or somebody that is trying to buy his first or maybe second company, maybe even a strategic buyer that is considering an expansion through acquisition. Private equity can maybe easily outbid them by just raising the offer price because they have capital to spare. Now, this is something that a lot of people need to be aware of, and I was talking about that with this person because some of them believe that acquiring a business is going to be very easy, and nothing can be further from the truth. A lot of people might be trying to sell you that idea, but based on current market conditions, it's becoming more and more challenging to acquire the right business, or at least a very good asset, because of the reasons that I just listed. And there are some things that you can do to kind of like fight this trend of competition and kind of like bidding wars that is happening in the market, especially in the US. Now, the first and most important thing that we need to consider is that this very harsh competition is happening for assets that are available in the market. So if you're talking to brokers, if you're talking to investment bankers, chances are you're going to face this type of competition, multiple bidders, even private equity groups that are trying to acquire smaller assets. That kind of like outlines the importance of having a proprietary pipeline. So something that nobody can take away from you, or a deal that doesn't have 4 or 5 bidders into the mix. That is so key because it enables you to have control over the transaction, and ultimately kind of like have more flexibility in the way you structure it, because the seller is not necessarily faced with multiple options. He's not courted by a lot of different people, and as a consequence, you can have an advantage from that perspective, a fair advantage. So having a proprietary pipeline of deals becomes even more important today. And even private equity groups are realizing that. In fact, they're investing heavily in finding their own deals instead of using third parties for doing so. Back in the day, they used to be a lot more lazy, if you will allow me the term. So they were okay with working with third parties, provided they were bringing them good deals that they could generate returns for them. But now that is not the case anymore. So they're realizing that it is important for them to be competitive when they source deals in kind of like exclusive to some extent. So having a proprietary pipeline is still one of the most important pieces of the puzzle. And most people don't realize that, especially some of the guys that talk to us when they say, well, we don't see you helping us in sourcing deals. Well, then they realize that the market is so competitive, and they come back to us saying, well, we've been trying to source deals for 6 months, nothing has worked out, now we need your help. And that's fine, we can still help them, but they wasted 6 months. So the point that I'm trying to get at is a pipeline of deals that is proprietary to you and exclusive to you, that you build off market with direct relationships with the owners, is what is going to make a huge difference in a competitive market like this. People are trying to buy assets, even the smaller ones. And to some extent, it is also important to mention that there's a certain cyclicality into deal making. especially when it comes to private equity. That has just been my experience. And again, happy to be corrected by other people, but I'm pretty sure about that because I've seen that being the case in a variety of different instances. Uh, Given the fact private equity groups are becoming more conservative, buying less assets and be more careful in the investments they make, they also tend to delay some of the investments they make because they want to find better opportunities. I saw a lot of them ending up at the end of the year, last quarter generally, with a lot of capital that they still need to allocate. And without capital allocation by the end of the year, they're not going to be able to show returns to their investors and kind of like they're going to mess up their entire structure. So I've seen a lot of them being in a rush in the last quarter for executing deals, driving pricing up almost to ridiculous valuations, even for businesses that might not have been so valuable in the first place. So when it comes to public listings and deals that are available in the market, what I've seen is that in the last quarter, and if you're watching this video, today is October, you've probably seen that already. Deals that are publicly listed will go up in value in the last quarter, and that is just natural because, again, a lot of these private equity groups or capital allocators need to allocate the capital. Otherwise, they're not going to be able to show returns to their investors. They're going to be in big trouble. They might need to give the capital back in some instances. So there are a lot of challenges that make these firms want to allocate the funds, even for small assets. And again, this is all tying back to my first point in the discussion I was having with this guy that wanted to buy a business. If you're only looking at public listings, you're going to be in a very competitive environment. If you're only looking at public listings today, so October, November, December, you're probably going to see prices that are completely out of the word, and you're going to wonder why that is the case. Well, some of the reasons are the ones that I just mentioned, and you should be ready to understand that and maybe wait for a few months before you can continue discussions with sellers and look at on-market deals. On the flip side, if you do have an off-market pipeline, so you build your own pipeline of deals, you created your own opportunities by sourcing deals directly from the sellers, you don't have these challenges because every deal is proprietary to you. And despite the fact the seller might say that he's entertaining other offers, based on my experience, in most instances, they're not. I mean, they might have another offer on the table, but generally speaking, people that keep their deal off market aren't really interested in entertaining a dozen different offers. They don't want to go through a process where they need to make a lot of decisions, talk with intermediaries, and do all these crazy things. Generally, they want a private conversation with a buyer that understands their needs and the transition that they want to make and kind of like the legacy they want to preserve. And then they want to make sure the valuation is fair for both sides and they can actually execute on the deal. So if you have an off-market opportunity, that can put you ahead of the competition, independently of that being private equity or other strategic buyers, maybe search funds, because that is becoming a thing today, right? There are tons of search funds out there. So off-market is still a thing, and what you need to be aware of about, when it comes to small business acquisitions is that, yeah, the market is competitive. There are a lot of bidders for fewer deals, but if you do create a pipeline that is proprietary to you, all these challenges will not apply because you have control over the process and you have the ability to make decisions not based on other people's bids, but based on whether or not you want to buy these assets. And you're ultimately going to end up in a situation where you have options at your disposal and you can pick the opportunity that suits you the best. In most instances, when it comes to on-market deals, that is not what happens because, and this is funny, because some people don't realize it, in a competitive environment, you start to look at a few deals, then you see that they have a lot of different bidders. You maybe lose your first pick, then you start working on the second, you lose that one too, and ultimately you start wondering, well, I should get a deal, otherwise they're gonna steal everything away from me, and you end up settling for something that wasn't so good in the first place, just because you're feeling like you're missing out and that everybody's taking the good deals away from you. So you end up making bad decisions just because you're influenced by the market that is very competitive. That doesn't happen when you have an off-market pipeline, because you have 4 or 5 different opportunities, deals that have been brought in continuously. So you say, okay, I have 4 or 5 that are more or less the same in terms of deal. I can work on one of them that I feel is my preference. Then if that falls apart, I have backups, but I'm not really making my decisions based on somebody else's actions, but I'm actually, wondering and pondering, the options, and then acting on that, using the information that I got without a rush, without fear of missing out, and all these sorts of things. So be aware of that. I mean, if you're looking at small business assets, especially this time of the year, valuations might be crazy across a variety of different industries. And if you are looking to acquire assets, you want to buy a business, want to find motivated sellers, check out my link below, because we help people source deals and build a pipeline of opportunities. And this is by far one of the best times of the years to build an off-market pipeline of deals, because at this moment, owners are going to be thinking about the year. They're going to be reflecting on what they achieved this year, and they're going to be also reflecting on what they want to do the next year. So if a decision is made about a potential sale, or even like a consideration about a sale is explored by the owners and the founders of a business, is going to happen in the next few months. And if you establish a relationship right now, off market, of course, then you can set the stage for a potential deal the first quarter of the year or something like that. Maybe even earlier, if the owner is really motivated. So if you want more deal flow, you want somebody to create a system that is streamlined, you can check the link below. We explain how we build that through a 3-step sequence: attraction, qualification, and bookings. So you can know exactly how we can source deals for you, book them in your calendar, and you focus all your time on closing deals instead of searching for them. So this is pretty much it for the video, and I will see you in the next one.